futures traders are now placing the probability of a quarter-point hike at 67%. Folks, that number was in the 40s yesterday, and whereas yesterday 55% were betting that the Federal Reserve would pause, that number has now dropped to 33%. What does that mean for stocks coming off the holiday shortened week where the Dow gained more than 0.5%, the S&P was down to flat, and the Nasdaq was down more than 1%? Let's turn to our floor show live for what the Monday moves could look like. Joining us now, Mizuho USA Chief Economist Steve Rasciuto and our Friday trader Keith Fitz-Gerald. So, guys, as we await the credit card debt report, so excuse me if we interrupt you for just a moment when Edward gets it. Steve, I want to start with you. We have a hint from the Fed funds futures turning toward another quarter-point hike. But how do you believe the markets will absorb it and react to it come Monday?
Well, I think the markets are going to have to take on board what it's telling them. First of all, it's telling them that there might be a further upward movement in interest rates, which, to be honest with you, is less important what they do at the upcoming meeting than what people think they're going to do by the end of the year. And the market has been vacillating between whether they begin cutting rates in June or July and whether they go 2 or 3 rate cuts, rather than just what happens in terms of the upcoming meeting. I really think the data that came out today tells you that the market's probably over-anticipating that transition in monetary policy from tightening to easing, whether they do or do not raise interest rates at the upcoming meeting. That's the real critical issue. And if the equity market begins to take on board that the Fed is not going to be cutting rates, not pivoting policy, we could see a significant correction in the market back down towards the lower end of the ranges we've been looking for. And our fair value range on the S&P 500 has been 3,700 to 4,100. We've attempted to break through the upside of that range, and now I think we're going to have to go back down and test the bottom end of that range.
We're at 41.05 as of yesterday. Keith, you're a stock investor, but I'd be remiss if I didn't show our viewers what the Treasury market was doing up until noon today. Bonds did trade until noon Eastern, and both the 10-year and the 2-year yield were rising. Keep in mind that it's coming off a pretty significant floor over the past week where we saw the 2 and the 10-year falling 10, 12 basis points, depending on which one. But Keith, talk to me about, as a stock investor, because that's your bailiwick, what you see come Monday.
Well, it's interesting because what the bonds are telling us, we do actually have a fixed income component to what we do. The bonds are telling us that it's going to be a risky day. There's going to be volatility. There's going to be digestion. So I'm not particularly concerned about the short term as much as I'm concerned about the possibility of a Fed blink. I still think that's in the cards, even though futures trades today, just prior to coming on air, really shifted radically in terms of a 25 basis point or even a reduction or a pause. That's really computerizations and arbitrage. So all of that's got to come into play Monday, Tuesday, Wednesday. Then things are going to calm down, and I think we're going to get a look at what the Fed might really do.
Steve, when you look at where the strongest job creation was in March, I mean, clearly the big winner has to be leisure and hospitality. 72,000 were created in that era. Biggest hiring wave there. Healthcare also looks strong. We can put up the graphic and see where else we saw hiring. But then, of course, manufacturing shrinking, and not to mention the tech industry not looking so healthful. Can we still, with the numbers that we got today, anticipate what's called a job-full recession, where you have a recession but not a jobless recession?
Yeah, this is going to be the interesting environment as to what type of recession do you come about. First of all, the labor market is clearly excessively tight. We have a 3.5% jobless rate. Yes, there are some industries that aren't hiring as quickly. There are some industries that are shredding workers. But, that's the seasonal flow and the cyclical flow we would get with inside of every business cycle. Whether or not we move towards substantially higher employment or not really comes down to the nature of the recession. And a lot of people, I think, are mistakenly assuming that the problems that we have in the regional banking industry can manifest themselves into what they want to say is a hard landing. Every recession is a hard landing, okay? There are some recessions that are harder than others. And I think if we're going to get a recession, and it looks like you are, it's going to be a very mild, very, very shallow recession, one which hopefully just brings the unemployment rate back to where it expresses a better balance between labor demand and labor supply, rather than the one we're having now, where it's a clear skew towards labor demand.
Yeah. So the job full recession could possibly still be in play. Keith, let's talk about where you would be going in equities in the next, Monday, you say, is going to be a little bit itchy, I guess, and a little bit jittery. So, but as you look at, say, for example, Tesla, there is news, big news that hit late yesterday that Tesla, for the 5th time this year, is going to once again cut its prices, but this time here in the U.S. on all of its models. So are you worried at all? And here are the price cuts that we're expecting. Aren't you worried at all that we may very well see some, profit margin compression here for them, and that could cause a problem for the stock?
Well, respectfully, I got to be honest. I'm looking at this as an opportunity, and here's why. Tesla's profit margins are 5-7 times the competition, which means they can cut from a position of strength at a point where GM and Ford cannot. So that, to me, is the economics 101. If it's going to go to profit margin, that gains market share. So I actually think that's going to be good for the stock. So at 185, I'm smart enough to buy some more come the opening bell on Monday.
Okay, so you would say buy some more. And by the way, it's at 185 right now. But if you look at Tesla at the moment, you can see that yesterday and the one-year picture, it's definitely up off the worst of, I guess, the real problems, which were back in January, but nonetheless. And finally, Steve Rasciuto, as we look at the overall picture of what you expect for inflation, here's what bothers a lot of people. Wage growth was still up about 4.6% in the month of March, and yet we know we've got consumer price index numbers from the most recent month that were 6%. So wages are not keeping up with inflation. Next week, we get the consumer price index number for March. Give me what it's going to be and what you think will happen.
Well, I think energy is going to hold the headline number down. I think it's the core that's going to be a problem. I think the core is going to be in the 0.4% area, which is going to show that we're holding ground on the year-over-year basis in the core. But again, with the energy coming off the mark a little bit, we're going to lose some of the top-line growth numbers. The real driver here is the core, because that gets to the point you were making earlier about the wage component. And as long as people are playing catch-up in their wages to what's happening in prices, it creates continued upward pressure on inflation. And that's why you look at the core so closely.
Yeah, I get it. Guys, happy holiday weekend. Thank you so much for joining us and preparing our viewers live as we get all kinds of info and data for Monday. Thank you so much.
Hi, it's Keith here. Thanks for checking out today's highlight clip. What'd you think? Did I make sense? Is there something you'd like to add? Make sure you leave a comment down below, and of course, click subscribe to keep up right here on YouTube, or sign up for the email newsletter at the link below. You can also find me on Twitter and Instagram for my real-time thoughts on markets, analysis, and a whole lot more.